Lot of familiar faces. I know it must have been a hectic day, but lot of exciting things are happening. I thought it is appropriate for us to come and speak to you all and take your feedback and praise this new product. You must be aware, you are looking at the first slide, Global Indices. We are at the verge of launching products based on both Global Indices. Mr. Sundaraman was supposed to come and take this session today. For the same topic, he is talking with few officials of SEBI who are right now somewhere in this building. So we have Mr. Arvind Goyal, who is the product head for this indices. So without taking any further time, I ask Arvind to just take up the session.
Good evening, everyone. In fact, I have met a few of you earlier for the same subject, I remember. While taking it forward, we all know that today investors in India can invest abroad, but there are certain limitations. There are certain problems which they face. There is a limitation of $200,000. Proper intermediaries are not available. The cost of trading elsewhere is very high. When they are trading, we are asleep over here. So various problems. So NSE thought, why not bring such a product to Indian investors in India, which will not have this currency problem. You can trade on the existing platform. You don't have to take, as members, you don't have to take new membership. You don't need extra infrastructure. As a client of yours, the person doesn't have to open a new bank account or sign new documents. With the existing structure, if we can provide a product which will, give them an opportunity to invest abroad. With that idea, we got into an agreement with CME, Chicago Mercantile Exchange, wherein a cross-listing agreement was signed. The cross-listing agreement gave them the right to launch derivative products on Nifty, which is an NSE-owned index, and we got in turn a right to launch derivatives on two of the world's foremost indices, S&P 500 and Dow Jones Industrial Average, DJIA for short. With that background, we went to SEBI and we applied for derivatives to be launched on these indices. You all know, I am sure you must have already seen the SEBI circular which was issued in January, which talks about a generic framework for any exchange which wants to launch such a product. So it talks about what kind of indices are permitted, who can trade, what are the risk framework, clearing, settlement, etc. So first it talks about the kind of investors who can trade. SEBI has permitted currently only Indian investors in this particular product. HNIs and FIIs and NRIs are not permitted. What kind of indices are permitted? They have laid down certain guidelines. These can be broadly classified into three types of eligibility criteria. The first is that derivatives on the proposed indices should already be available on certain specified exchanges. Some 24 exchanges have been listed by SEBI. Secondly, their trading volume or the market capitalization of the index should meet a certain criteria. And third, the index should be broad-based. That is, it should have a certain minimum number of constituents, and a single constituent should not have more than a certain weightage. Very fair. Both our indices, which we propose to launch, S&P 500 as well as Dow Jones, fulfill all these criteria. So they are eligible. We applied to SEBI and SEBI has given us permission to launch futures on both these indices. We would also like to launch options. I will talk about it later. Rationale, well, I have already covered most of these points. As I told you, we can invest abroad today. There is a route available, but there are limitations. Even if you invest, you have currency risk. You have invested in IBM stock over there. IBM grows by 10%, but if your exchange rate goes in an adverse direction, the net gain could be just 2%. So you have that risk. So what does futures or derivatives on global indices offer you or the Indian investors? A unique way. You get unlimited and hassle-free exposure to the US market. That's the biggest advantage. There is no currency risk as the clearing, trading, settlement, denomination of the contract, everything will be in Indian rupees. So you don't have to worry about the exchange rate at any point of time. There is no impact of currency rates on this product. S&P 500 and Dow Jones have a very high correlation. It is more than 95%. Past data for even 10 years, if you check, it is always greater than 95%. They are very highly correlated. But due to various circumstances, due to various factors which I will cover later, they do diverge, and that gives a very good opportunity for pair trading. I am sure all of you are doing pair trading of some sort. We'll talk about pair trading about these indices also. They can also be used for portfolio diversification. If your clients are investing only in India and they want to diversify, this could be a very good method. We'll see why later. As a member, as a client, no changes. The product will come in the existing F&O derivatives segment. No change for no new segment, no new membership, no new infrastructure. It will come on the same trading screen. Your same clearing, settlement functions, everything will remain the same. So for you, there is no new investment. For the client, as he will be trading in the F&O segment itself, no new paperwork. I'm sure all of you have heard about S&P 500 and Dow Jones. You must know pretty much about these indexes, but we'll cover a few facts. S&P 500, one of the most traded indices in the world in terms of trading in derivatives, number one in the world. Constitutes of 500 stocks from the US economy. It's a free float capitalization index. Market cap is $12,000 billion. The largest constituent has a market cap of $400 billion. That would happen to be ExxonMobil. Its weightage is 3.46%. If you take the top 10 stocks, they would constitute around 18.7% of the weightage. Now these 500 indices cover almost 75% of the US equities. So it represents the complete US market. The contracts are traded, the derivative contracts on this index is traded on CME. There are two types of contracts, a normal S&P 500 contract and a mini S&P 500 contract. We'll see what is the difference between these contracts. But the basic difference is that the E-mini S&P 500 contract is traded the most. It is the highest traded contract in the world as compared to the normal S&P 500 contract. This distribution of industry representation in the index is very important because this is what differentiates the index from Dow Jones. Because even Dow Jones represents the US economy as a whole. But the industries, here you will see financials, healthcare, infotech are heavyweights as far as the index contribution is concerned. We will see how it changes when we move to Dow Jones. The other factor, the historical daily volatility. We have seen data for the past 10 years, it is 1.35%. It is not very different from what you see for Nifty. Nifty, I believe, is 1.64%. So it's not much far. Dow Jones, the number of constituents is only 30. It's a smaller in size, around 1/3 market cap. It consists of the 30 blue chip companies, top 30 companies of the US economy. If you see over here, It is the industries, oil and gas, consumer goods, technology, which are the heavyweights over here. The second difference is it is a price weighted index. It is a price weighted index. So these differences make the behavior of these two indices a little different, and that is why, although they are highly correlated because they both represent the US economy, they will have divergence every now and then, which will give you trading opportunities as far as pair trading is concerned. Again, historical volatility of 1.27%, close to what we see for Nifty. Derivative contracts are traded on CME as well as CBOE. Now these are the contract specifications at CME for S&P 500 and Dow Jones. We have put both S&P Mini and Dow Jones Mini and the normal contracts. Basic difference, the size. Mini is smaller in size. This is the bigger contract. Mini is traded on their electronic trading platform. CME has an electronic trading platform known as Globex, which runs 23.5 hours a day. So around the globe, round the clock, trading goes on Globex. These contracts are also available. These are traded in the pit as well as on Globex. So CME has two types of trading platforms. One is the pit, the erstwhile, where the trading was face to face, not electronic, and the other is electronic. So basically mini contracts are traded on the Globex platform, and mini contracts are the one which are traded the most, as I told you. We should concentrate on this because this will relate close to what we are going to offer. The size is 50 USD over there. Here it is 250, 5 times, 5 and 10, 2 times. They have quarterly contracts. We are also going to offer quarterly contracts and futures right now. When we talk about options, I will talk about other types of contracts also. Trading is available round the clock. As you can see, the trading time. The last trading day for these contracts is the third Friday of the expiry month. And trading on Globex, which is the electronic trading platform, is available till 8:30 AM in the morning. Friday morning US time. The settlement price, the final settlement price for these contracts is something known as SOQ, Special Opening Quotation. Well, it's very simple to understand. It is calculated the same way any index is calculated. The only difference is that each constituent stock's first opening price is taken to compute this index. Whenever the stock will open, the first price for the day will be taken, and all those prices will be used to compute SOQ. And against that price, the settlement will be done. Now, we have talked to many participants in India, and we have seen other contracts wherein foreign indices have been offered multinational in multiple countries. What we got to know is, whatever we do with the contract specification, the settlement price should be the same as in the home country, and that is what we are going to do here. We will talk about the contract specifications when we come to that. I was talking about the correlation between the indices and how they throw up opportunities for pair trading. This is a 10-year data for Dow Jones and S&P 500. Both are very, very closely correlated. This is the data. You can see for 10 years it is 96.77%. Highly correlated, but as I told you, both indices computation is different methodology. Secondly, their constituents are different. The industry weightages are different. Therefore, at times both indices behave differently and throw up opportunities for pair trading. But if you see the average, it will always come in merged. Since both contracts will be offered to you with the same settlement date and the settlement price of CME itself, you will have great opportunities for pair trading. If you look at the other way around, Nifty is not correlated or not highly correlated to both these indices. Now that gives you another opportunity for diversification. People who are exposed only to the Indian economy, they can take exposure to this economy as a very good diversification. Average daily volatilities of various international indices. As I told you, both these indices have almost the same or closely related volatilities. Again, an indication that you have good trading opportunity. Any questions so far? If there are any questions, please speak up. Well, as I told you, the volumes are quite high for these contracts. You can see the annual volumes compared with Nifty futures, contracts in millions. For S&P 500, the E-mini contracts only itself is very high. Mini Dow Jones as compared to S&P is less, but even that is a very popular contract.